5-star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hey y'all, what's going on? I'm Andrew from the Options Millionaire community. I appreciate you taking the time to watch another video from the educational series. And if you haven't already, be sure to hit that subscribe button so you get notifications for all future content, as well as our Monday, Wednesday, Friday live options trading streams. Today we're going to be talking about, in my opinion, the single biggest effect you can have on your trading strategy. Everything that I've learned in the past 11 years has boiled down to and rendered down to this one particular subject. I'm incredibly passionate about it. It is the foundation of my system and everything I teach in the community. So stick around to the end, because I guarantee you that this will bring a ton of value to your trading system to help you become more profitable day in and day out. So I want to paint a picture for you. Pretend you're a brand new trader. You just opened up your first brokerage account. You just put your first little bit of money in there. You don't really know what to do, what to ask, what to research, what to Google. Don't really have a good handle on anything. You start to go to look at the charts, and this is what you see. What does a traditional trader start to do? What's the first stuff they usually see around the internet? Well, it's what I call the low-hanging fruit. First, you put your first EMA line on there. Looks something like that. And then you start throwing on a little more EMAs. Maybe you do the 8, 21, 34, 50, all these other EMAs that people talk about. And that looks a little something like this. Boom. And then, of course, you throw the standard deviations on VWAP on there. That looks a little bit like some sort of crazy haze cloud. And then maybe on Twitter, you read a little bit about the Fibonacci bands. And it looks a little like this. Boom. A couple of more lines. It's like, hey, this is looking really fancy. I'm starting to become a real trader. Well, after this, how about a little bit of standard deviation? Boom. Little blue, little yellow. But that's not quite enough. How about I throw another indicator on there of another moving average? Boom. Sweet. Now we've got about 15 lines, a couple of deviation bands, a little bit of shading. Starting to look a little fancy, but that's not enough. How about some sub-chart indicators? Oh, I know. This guy told me about MACD. Boom. Excellent. Okay, so now I have even more MACDs telling me when I should, when I shouldn't. This is starting to look pretty good, but I don't think that's still enough. Someone told me about RSI. I see that one thrown around all the time. Let's take a look at RSI. Bam. Excellent. All right, now it's starting to look extra technical and super fancy. Now when I show screenshots to all my friends, they think I'm a real trader. Now, I know this is starting to get a little comical, but you could see the problem here. And this is actually pretty dang common, especially seeing a bunch of new traders who don't really know where to go. Their first step in trading is to start doing this right here, putting a whole bunch of crap on their charts that is just confusing them. This is not trading, this is charting. And a lot of people make the mistake of confusing their trading system for just looking at indicators. Every single one of these indicators is a reactionary measure based on some sort of calculation of price action. So in my opinion, why would you want to be a trader based off of reactions off of price action? Why wouldn't you want to trade the price action itself? And that's where this system, my system, and this video really steps into coming to play, because when you can learn to trade price action, you can get rid of all of this and just get back to the basics. It really is that simple. All you have to do is follow the price action and the volume and learn to trade level to level. And that's precisely what I'm going to show you how to do in this video. The world of investing has changed drastically in the past years/decades. I think it's a pretty well-known fact that nowadays the price action is dominated by computers, high-frequency traders, algorithms, etc. Now, the good thing about all that is that the market loves to trade at key pivot levels. And you are going to be surprised at how easy it is to identify those key pivot levels, where the market wants to bounce, where the market wants to reject, move up or down, pivot away. And you do that by placing key levels based on time periods in the market. Now, I place levels based on 3 key periods. 1, the prior session, high and low. 2, the extended hours, high and low. And 3, the current day, high and low. And I'm going to show you exactly what that looks like. All right, so we're going to look back to November 23rd as a good example of exactly how to plot these levels. So what I've got notated here is the prior session, settlement open, which is the start of the overnight hours, and the current session open. These are times are Central Standard Time, so note that, 8:30 Central Standard Time. So what I'm going to do first is plot the prior day low. So I'll plot a line right there, line segment right there. And then next I'll plot the prior day high, which looks like that. All right, so I've got those 2 lines plotted, and after that, I'm going to go to the extended hour session. This is the nighttime hours. I'm going to set the extended hours low right there, and then I'm going to set the extended hours high right there. So you see I've got 4 key levels in the market. You can already see how the market loves to respect a particular pivot pivot in the market. We don't know how or why the market rejects this particular level, why they predict this particular level. However, we just know that it's there, and that is our job as traders, to figure out where the market wants to pivot. So we rejected that in the last trading session. Market closes, opens back up for extended hours after settlement close, and then we pretty much respect that level the entire evening. We carve out a little bit wider channel here, 4,021 to 4,002, and then the market kicks off. And what I want to do here is show you exactly how the market reacts to these particular levels. So I'm going to go ahead and hit play on this and just see what happens. So first out of the gate, there's the market opens. We have the big influx of volume and price action. Boom. And already out of the gate, we get some pretty bullish action here. Right at the gate, we go green. We go above the pre-market high. But you see, we already do a supply retest. We break above supply, come back and retest twice on that key level. And that's no coincidence. And we move a little bit higher here, and now I'm just watching to see how the market moves. We consolidate a little bit. Things are starting to look bullish. We finally get a little bit of a breakdown. And then as we start to drop here, we're going to look for key targets. Now, things start to get pretty bearish pretty quick, and a lot of people are looking to start to go short this market. They think, oh, the momentum is coming downside. We start to get the hot hand theory where we think, oh, just because we're dropping, we're going to continue to drop. However, in tying with these levels, and where the levels really come into play here, is where I start to remember the stat that about 80% of the time the market consolidates within a range and 20% of the time the market trends. So knowing that and trading probabilities, probability says that unless there's some major outliers, that I'm going to look to take calls off the lows and puts at the highs. And these levels really start to shine when I really embody that principle. So here, what I'm looking for is to see how it's going to react at the pre-market lows. That is a key level on which the market loves to pivot. And what happens this time? We fail, we break down, and then we start to consolidate here. And I know from experience that the market loves to bounce off pre-market lows at least once. So you can bare minimum make a quick call scalp off the bottom, or maybe you get a trend reversal back up and you make some fantastic money on holding a call off the bottom. But knowing to identify this key pivot from pre-market saves me from chasing puts through a breakdown. I know the probability says that 80% of the time we're going to bounce off a key level. I just have to figure out what that level is. And here we've identified the pre-market lows, and that's precisely where it bounces off of. And look what happens after we bounce off of it. We go right back up. So knowing this level could have done one or two things from you. One, keep you from chasing puts to the downside and getting smoked, because a lot of people complain, oh, I just took puts right at the bottom. I just took calls right at the top and I got blown out. Well, because you don't know pivot levels in the market. And then two, you could have taken a call here and make some great money on a retracement. But let's look a little further. Let's dig a little further on how accurate this actually can be. You see that after we come back up, what level do we use as, again, continued supply retests here? Once again, the pre-market highs. And this is 1, 2, 3, 4 supply retests. And what is a supply retest? When we break through the first level, and then before breakout, we come back and retest that supply and then bounce. That's why, a little side note here, when you play breakouts, you don't want to play the initial breakout, you want to play the breakout retest. Now, in addition to those 4 levels I post, 1, 2, 3, 4, I post 2 more levels that give me even greater insight into the day. And that is the current session high and low. And I adjust those based on how the market carves them out. So right off the bat this morning, if I would have posted this level and then this level, now I've got an additional levels to show out where the price action is going to move. And we come up and look where we bounce off of the day's highs right there. Bam, bam, bam. And then when the market closes, we consolidate in the extended hours. So you see that there's a key level right there at 40.38 that I know the market does not want to break through, and that saves me from chasing calls to the upside. So you see, once you start to plot these levels, the pivots of the market, the hidden supply and resistance zones that we cannot see behind the scenes here. If you were to pull back this curtain and see all the gears and sprockets and hamster wheels behind the screen, you would see that there are key levels and resistance and pivots and order flows in the market that we just can't see. And plotting these levels allows you to identify those levels and keeps you safe. It keeps you from taking calls here, and it keeps you from taking puts right here. Let's look at another example. So this time we're going to go back to November 14th. We're going to plot Friday's lows, which is right here. We're going to plot Friday's highs, which are way up there. And then the current session, the low is way on down there from CPI, so I usually don't bother with that one. And then after this, we're going to plot the extended hours trading high and the extended hours trading low right there. So we have our 4 levels. So I'm going to hit play and let's see what happens. So there's the play button right there. And already off the bat, we have a nice test right there off of pre-market lows. We come up, we briefly breach over pre-market highs, consolidate it right around it, fail, come back down. Once again, boom, test right off of pre-market lows and bounce back up. So we're already right here, you see the value of not chasing puts at pre-market lows because we continue to bounce off of it. And then we're consolidating right around pre-market highs, testing the resistance zone here, the supply order flow right there. And let's see what happens. Let's hit play. Continue to consolidate around there, finally break out. And then we come right up here and we have a test of the pre-market highs. Again, consolidating, can't break through. Continue to consolidate, another test here. We do finally get a little puncture of that pre-market level. We consolidate right around it and then eventually, boom, fail it again, right down. So again, you can see the pre-market lows saved you from taking puts to the downside. The pre-market highs save you from taking calls to the upside and getting blown out on reversal. Yeah, you probably could have got a little scalp call there, but in speaking in terms of risk reward, you don't want to be taking calls at the highs without some sort of confirmation or retest. And then boom, finally we come out there, test pre-market highs for one last time and then reject down, come all the way back down. We breach one candle through pre-market low. And once again, remember what we said earlier, you don't want to take puts off the first breach of the level. You want to take puts off the first retest of the level. And we come up here, we retest, we do fail, but once again, we come back and we glue to the pre-market low area. And you see, there's a reason why the levels glue to particular levels. There's no coincidence that the market rejects and bounces here and rejects and bounces here. There's a reason why, and it's order flow, it's the mechanics, it's the programming of the algorithms that trade the market, and learning how to plot these levels saves you from chasing and keeps you apprised of the entire environment in the market. It allows you to exploit those levels by taking calls at the lows and puts at the high, and then confirming when we do break down or when we do break out, you confirm appropriately based on these level retests. Now, I also want to show you one thing that's more of a macro perspective. It's also the increased value, because trading these scalps and day trades is not just the only way to play these things. It gives you a larger perspective of the market when you learn to zoom out. And I'm a huge proponent of doing your market analysis from big to small. Start out on the weekly chart, the daily, the 60-minute, the 15-minute, and filter all the way down to the 3-minute. Being apprised of the macro environment will only help you become a better trader, whether you are a swing trader, a long-term trader, or a scalper. Being apprised of the macro condition of the market will only benefit you in a very large way. And I'm going to show you an example on how that actually does that. So this is from the time period of Thursday, November 10th through Tuesday, November 22nd. And that's a 12-day period. That's a lot of time for the market to consolidate in such a tight range. But there's one key level here that really stands out to me in this market, and that is right there. And you see that whenever the market falls, it bounces off of it here, 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 consolidates there, finally breaks through, and guess what? Comes right back to it, rejects, bounces above it, always returns to this 3960 level. And being aware of this particular level when you are trading, remember this is a 12-day range, so these are different days. You can be apprised, and if you've got this level notated on your charts, you know that this is going to be a big level to break through, and it's going to require a lot of momentum and order flow in order to puncture this level, and that'll keep you from looking for a big drawdown until we get a break free from that. Or it'll get you from taking calls when we finally do extend away from this level, because that's what I'm looking for. When I see a level like this, I'm looking for extension away from this level. How is the order flow sufficient enough to finally get us away from this level, whether it be up or down? If I see the order flow coming down, I'm going to look for final extension and then finally breaking our key levels. And then to the upside, I'm looking for extension to the upside and then breaking these key levels to see if we can go long. And we still haven't done that yet, by the way. A little bit of market awareness for the current setup here, that we still haven't broken over the prior rejection zone. So I am not even bullish until we break over these key levels and break out and extend away. So a little bit of FYI. But just to go to show you that the level-to-level trading doesn't only apply on scalping, it can apply to the macro level. In fact, for my Tier 2 subscribers, I provide macro levels, and that's precisely what these levels are based off of. These are key pivots in the market that go all the way back as far as I can, years and years, because the market always respects levels. It doesn't matter how far back they go. The data that you can bring in from years ago still applies to today, and the price action still respects those levels, even from 2021, 2020. And these key levels allow me to identify key pivots in the market on a macro scale. This is the daily chart here, and you can see that even still, the market loves to bounce off of and reject these levels. There, and then once again, we're bouncing off of here. But I want to show you one more example on just how far back these levels can apply and how they can help you manage a trade or identify a trade in a current market condition. I want to look at Tesla to do that. So Tesla in the past couple of months has gotten creamed. It's not normally something I trade because Tesla is heavily manipulated by the options chain. But on this particular instance, after a month and a half of straight of getting creamed in the market, I became long on Tesla at 167. Now, why at 167 and not 178 or not? Why not at 200? Well, because of this level right here. If you go all the way back to 2020, Tesla had this level right here. We had the first breakout here big rejection, gap down rejection, consolidate, that we had another retest here, and then finally retest absorption, and then break out. And they continue to break out for a number of months, and then finally consolidating. So when we finally broke down a year and a half later, the market finally broke down heavily, gapping down, red candles, no bottom wick at all. And then I became long at 167 because of that level. And it just goes to show you that this is not coincidence that we just bounced randomly at 167. It's because the market trades level to level. The computer's programming this stuff, and it goes back from September 2020 until November 2022. Over 2 years later, the market bounces perfectly off of this retest level. And we are able to identify a long call position and made a killing off of this level. So I hope you can really see the value on identifying key levels in the market. I believe identifying these levels right here without doing all the crap and all the lines and all the nonsense and EMAs and MACDs and RSI, I think this level trading system here can be the single most impactful thing to your trading system to identify the market awareness and key pivot levels in the market. If you can identify the price action itself, then you can start to become a better trader. Not the calculations and equations of reactionary price action measures like EMAs and all the other nonsense that are reactionary in nature. But if you can learn to identify how to trade actual pivot points in the market, simple little bitty lines drawn on your chart that are pivots, you could start to learn to identify that price action, become more advanced with it, and you start to get that quote-unquote spidey sense to know when the market's going to break through and when the market's not going to break through. Now, there's another key component we're not really going to get into on this particular video, and that's volume, and that's where you start to build into volume price analysis, and I am a key volume price analysis trader. And the volume, when you start to tie in volume manipulation and volume movement along with the level-to-level trading, you can really start to paint a broad picture and refine your skill set. But we'll talk about a little bit more VPA trading in another video. I do have a couple of videos already posted about some basic VPA stuff. Links are going to be down in the description of the video if you want to watch those. But we'll continue to dive even more into VPA trading in the future. But I promise, guys, trading is already difficult enough. We don't have to go and make it more difficult. The market will tell you where it wants to go, where it rejects, and where it wants to bounce. As long as you're willing to do your due diligence and then make notes and pay attention, you can learn to exploit those levels. So I'm going to leave it at that. Let me know if you have any questions. Please comment down in the description of the video if you have any comments or questions about what you've seen here. Come over and join the Discord. This is what we do. We talk together, we learn, we identify the pivots. This is what we do every day in the Discord. It's a fantastic communal educational resource that's a lot different from the other Discords out there. If you haven't already as well, come over to Spotify and listen to the podcast. I have a Making Millionaires podcast. I try to post episodes at least once every week or so that go over content based on educational, based on emotional, based on growth, based on inspiration, everything that kind of is really I'm passionate about, I put in that podcast. It's a great listen that you might be able to derive some information to make you a better trader. Once again, I appreciate you taking the time to watch this video. Please hit the like button and subscribe so you can get notifications for all future content, as well as our Monday, Wednesday, Friday live streams. And until next time, I want you to remember that the only thing separating you from financial greatness is the decision to be better. I'm out. See ya.